Hey, good morning, and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And last week, we had a inflation print that largely ruled out the chances of a 50 basis point cut here in the month of November. And we had a kickoff to earnings season that really seems to have so far accelerated the equity markets to the upside. So let's take a look at the charts where we stand and what our views are. We have the S&P 500 breaking out to new all-time highs on Friday and once again here on yesterday. This is a pretty strong bullish signal that we've seen here from equities on the S&P 500 printing new back-to-back highs on what is fairly, decent volume here. You also have the Nasdaq 100 breaking out above recent highs. We've talked about the fact that, the Nasdaq struggled to get above these resistance levels, starting to show some strength here. This really puts the all-time highs back into play here from the Nasdaq 100's perspective. And then you also have small caps, IWM, Russell 2000 very much within spitting distance of those all-time highs. If you get the Nasdaq and the Russell 2000 to break out to new all-time highs in conjunction with the S&P, you have a pretty strong bullish signal here from equities. We do start to get what I would consider a fairly crowded trade as we see that happen, where participation on this equity rally here is pretty broad. There certainly are concentration with regards to tech, with regards to, Chinese stocks. So this is something to, be aware of, just that, right now there's a lot of enthusiasm for equity markets. You also have the fact that, the RSP equal weight S&P 500 index confirmed a new high. And what this simply means is that there is broad participation on this equity rally. It's not just a few names that are, tech names that are dragging the markets higher. You really have, the rest of the market participating in this rally. And that is, generally speaking, a strength here for equities, or confirmation of the new all-time highs here at equities. So overall, you have a very positive backdrop here for equities at the moment. If you look at the major indices, you look at value versus growth, there really isn't any particular factor that's outperforming here right now. Again, speaking to the fact that this is a pretty broad-based rally, you don't really have growth or value kind of leading the markets higher here. Kind of everything is moving along, which is really interesting. Commodities pulling back a little bit here today after what has been a really strong month here for commodities. This is largely on the back of oil prices falling quite a bit here over the last trading session. So commodities perhaps going to see a little bit of consolidation going forward with commodities. You have high yield corporate bonds continuing to kind of price in what is relatively low risk of credit default and concerns around credit, and whether it's consumer or corporate credit. Right now, the bond market is not particularly concerned about that, which provides a bullish backdrop here for equities. The one thing to note here is that as the S&P 500 prints back-to-back all-time highs, you still have the VIX trading at around 20%. Now, this is going back through history. I couldn't find another instance where you had back-to-back all-time highs on the S&P 500 where the VIX was still trading, above 20% or around 20%. Almost every other instance of the S&P 500 making new all-time highs back-to-back, VIX was somewhere in the 13 to 15 level or lower. So this is pretty unprecedented in terms of just the nervousness from investors as equity markets make new all-time highs. Usually there isn't this much nervousness around the S&P 500 making new all-time highs, whether that's geopolitical tensions, whether that's the upcoming election, whether that's just general economic uncertainty. I think there's a little factor of all of that mixed in there. Um, Now, you could think of this as a bit of a contrarian that as we make all-time highs, that investors are still holding on to a lot of fear, that if they were to let go of that fear, that potentially becomes a very bullish um, factor here for equities. You also have the fact that analysts have been revising earnings expectations lower going into this earnings season. That sets a pretty low bar for equities going into earnings season. That's why we've seen stocks like JP Morgan report better than expected earnings. Is it truly because they've got really strong earnings, or is it because analysts have lowered their expectations and we've simply met a lower bar? Um, the answer is that we certainly are meeting a lower bar. It doesn't mean that equities aren't performing well as well on top of that, but we are certainly facing a much lower bar, which gives us a higher probability of companies beating the earnings expectations and potentially trading higher from that. So overall, everything that we're looking at so far is providing a pretty significant bullish backdrop here for equities. Um, and I always like to just be aware of that sometimes, right? Because sometimes when everything points to being bullish, that's when some of the downside risk starts to rise. But overall, we do have a very positive backdrop here for equities, with the exception of kind of the VIX pointing us to that investors still have a lot of fear about equities as they make new all-time highs. You have the 10-year yield still hovering around 4%, moderating a little bit here yesterday. Bonds continuing to sell off, perhaps selling off now to a kind of major support level, maybe finding a little bit of support here. So we'll see if this kind of provides a bit of a level here for yields to stabilize and for bonds that start catching a bit of a bid here. You do have the dollar index starting to moderate around that 103 level, which is a major support and resistance level that we think that, from a exposure perspective, the risk to reward favors adding some bearish exposure at these specific levels on the US dollar. And then gold continues to kind of hover around this 2650 level here. Our upside target remains 2750. We're within spitting distance of actually tagging that 2750 level. We got close here a couple of weeks ago. We're looking for some potential further upside here. But oil, we've really seen oil kind of pull back a little bit from that peak around 78 or so. We're trading at around 73 or so after what was an initial huge spike, more so back on the geopolitical tensions, but perhaps as the initial concerns that Israel was going to target Iran's oil producing facilities, kind of maybe some of that fear starts to subside a little bit. We've also seen oil prices fall alongside with that as well. And then when we look at sector rotation, we really see kind of a risk-on environment here. You have technology outperforming, breaking out to new relative highs, outperforming the S&P 500. You have consumer discretionary, losing a little bit of ground. This is one of this is one of the few consumer sectors, that is losing ground relative to the S&P 500, kind of signaling a bit of a risk-off environment. Communications, as you can see, failing to kind of break out to new highs, or actually generating new highs, but from a relative perspective, losing a little bit of ground here. Financials, on the other hand, taking off here. This was on the back of kind of JP Morgan's earnings. We've really seen financials take off here, making a new relative high, outperforming the S&P 500. Consumer staples, as you can see over the past month or so, has lost quite a bit of ground. So the defensive sectors are losing ground and the offensive sectors are gaining some ground. And that's really kind of providing that risk on backdrop here. As you can see, healthcare losing quite a bit of ground, a defensive sector, materials losing a little bit of ground, but largely, as you can see, performing better than The S&P 500 over the past couple of months. Industrials have really taken off here over the past few weeks. Um, Real estate losing some ground here to the S&P 500. So overall, you have a pretty significant kind of risk on environment. Utilities losing quite a bit of ground here over the past couple of weeks. Home builders um, trading near those recent highs here, but home builders, I do think starting to lose a little bit of ground here to the S&P 500 as well, and then semiconductors gaining a little bit of ground here. Despite the fact that there were concerns that the U.S. were going to curb AI chips to China, we started to see semiconductors seek its started to break out above recent highs and starting to outperform the S&P 500, showing us that there is some upside potential here in semiconductors, despite some of the concerns around whether or not the U.S. will start curbing chip sales to China in regards to some geopolitical risks there. So semiconductors showing a little bit of strength here. So overall, you have a very, I would say, positive backdrop here for equities, and even within rotation, you're seeing a very kind of risk-on type rotation that we're starting to see here from the sectors. So looking at the ideas from today, that kind of reflects this fairly bullish tone that we see here for equities, especially kind of going into earnings season. First one I want to point out here is Disney. Disney, as you can see, for quite a period of time has been underperforming the S&P 500, has been forming this bottoming formation here. And the question is whether or not we can see Disney start to break out here to the upside. And this is really where, the fundamentals start to look a bit attractive here for Disney for quite some time, I would say. The fundamentals still looked expensive here for Disney, but trading around this $95 level now, we're trading about 18 times forward earnings. Growth expectations are fairly strong here relative to its industry. Net margins they're not great, but they certainly are getting better. And Disney, if you look at trailing 12 months, just saw record revenues and net income, which reflects kind of a turnaround here for Disney. And I think that the charts are starting to show some stabilization, and here's an opportunity for Disney to potentially start outperforming the S&P 500. The next one I want to take a look at here is Shopify. We continue to maintain a bullish exposure here for Shopify for many weeks. We started telling you about this when it kind of broke out here from the $67 level and retested it as support. Now trading at 83, our upside target here is still just above $90 or so. So we're maintaining that upside target until we get to around that $90 level. And then we'll reassess. From a valuation perspective, we still believe Shopify is still undervalued and at the very least trading at a very fair valuation relative to its peers, because it is trading at a valuation right now that is alongside its peers, despite the fact that it's expected to grow significantly faster than its peers. So for those reasons, we still maintain a bullish outlook here for Shopify. The next one I want to take a look at here is Johnson & Johnson. As you can see, we've kind of bounced, we broke out above 160, came back to retest this level as support, and now we're expecting a further upside here from Johnson & Johnson. This is more of a short-term trade up to that $168 level here. If we can break out above 168, then we have some further upside. But valuation-wise, it trades at 15 times forward earnings, which is just a little bit ahead of its industry, but it is significantly more profitable than its peers. And for those reasons, I think it justifies a small premium. And I actually think it justifies a pretty substantial premium relative to its peers. When right now it's trading at about 8-9% higher than its peers from a valuation perspective. So because it is so much more profitable, meaning for every $1 they earn in revenue, they are generating far more net income than their peers. Johnson & Johnson, in my opinion, deserves to trade at a higher valuation. The next stock I want to take a look at is Akamai. You might not be looking at this stock in your portfolio, but this is a stock that very similar to the kind of that Disney chart where you've seen a pretty significant decline in this particular stock over the past year or so. But overall, what we've started to do is we've formed this kind of bottoming formation that it's just starting to break out here. It actually just broke out here at the end of last week. We've held this 102.5 level here as support, and that's kind of the upside potential that we see here for Akamai. Trades at about 15 times forward earnings, which is a significant discount to its peers. It is expected to grow at a pace that's a little slower than its peers. Slower and faster in some regards. EPS growth is meant to be a little slower than peers, but revenue growth is expected to be faster than peers. And I do think that revenue growth factor is actually the more important one. And it is equally as profitable. So the fact that it trades at about a 40% discount relative to its peers, I think this is really an interesting play because they do content delivery systems through edge servers, and as we think about the um, rollouts of AI tools and features, edge servers are going to play a fairly significant role in being able to deliver those AI services or products, to users in an expedient fashion and in a safe fashion. Edge servers provide kind of a relatively key technology for that. And Akamai is the largest distributor of that and provider of those services. And I think that's really the upside potential here for Akamai. And the charts are showing some initial signs of interest from investors. And I think that this is potentially an early opportunity for this stock to start trading back towards the valuations that its peers are trading at. The next one I want to take a look at here is Airbnb. Similar to some of the other charts that we're taking a look at here, Airbnb kind of taken a bit of a hit here over the past few months. Taking a bit of a hit here over the past few months, but over the past few weeks, playing a bit of a bottoming formation and starting to break out here. Above that 130 resistance level here. Airbnb trades at a premium relative to its peers from its industry. However, it is significantly more profitable than its peers and expected to grow at a rate that's slightly lower than its peers, but kind of very much strong growth relative to the S&P 500. And for those reasons, I think the valuation is somewhat justified and still represents some upside here into that 150 level here on Airbnb. Next one I want to take a look at here is Bristol Myers. Bristol Myers is one that we've been bullish on for quite some time. But overall, as you can see, this $51 level has been an important level of kind of a bottoming formation. And if we take a look at kind of a weekly chart here, you have this kind of bottoming formation that's been bottoming for quite some time after what has been a period of underperformance. And we're just starting to peak its way out above that level. We've actually just come back to retest that level as support. It trades at a pretty significant discount relative to its peers, trading at about 7.5 times forward earnings. It is currently, over the last 12 months, not profitable, but that's starting to be turning around. It is expected to turn a profit in 2025 and beyond. It's expected to growth both top and bottom line significantly faster than its peers. And that's really kind of the opportunity that I see here for a stock like Bristol Myers. Another one we still continue to like here is Meta. Within the AI kind of arms race, Meta kind of stands out. Their open source models have recently performed on par with ChatGPT's open AI models from a benchmarking perspective, and a lot of products and services within the AI industry are starting to leverage kind of Meta's models for large language. But more importantly, investors over the past few months have really shown us that they are concerned about tech companies that are spending lots of money on AI without a clear sense for how they're going to derive future revenue from that. And I think Meta has clearly heard those concerns and have addressed those concerns and have started to roll out AI products across all of their businesses. Whether you agree with, their businesses or not, that's a different story. But they have certainly rolled out AI tools across all of their Instagram, WhatsApp, Facebook products, and they are now supporting multimodal. So you could do image, you can do text, you can do sound, you can do audio. Their AI supports all of those different medium um, sources, and it's really, I think, perhaps a better integration than what Microsoft has had, even though Microsoft has had the lead in terms of with AI and being kind of having first market mover advantage. Meta, I think, very much has played catch up and in some ways have already leapfrogged what Microsoft has done in terms of integrating OpenAI into Microsoft tools. So for those reasons, I think Meta belongs on the leaderboard with regards to if you're investing in AI as a theme, Meta very much is a company that is showing investors that they are figuring out how to incorporate AI into their products and generating revenue from that. And that's taking market share away from stocks like Microsoft and even Apple and Alphabet. So Meta, in my opinion, is the top pick within the major tech stocks from an AI perspective outside of the semiconductors. Another one I still continue to like is Nike. We'll see if this will remain on our bullish list here because we initially had this view that we're going to break out here above 85. So far it's pulled back here. It's still holding the initial breakout level here, which is around 80. We're still looking for some upside here. If it breaks below 80, that would invalidate our bullish thesis here on Nike. We've maintained this bullish view on Nike for quite some time. We'll see if it continues to move higher here. It does trade at a slightly higher valuation than its peers, but it is also growing faster significantly than its peers. It is more profitable than its peers, which justifies its premium valuation. But ultimately, you are paying a premium valuation for Nike, and we'll see if that proves out to be worth your while or not. And then I will leave you with one bearish idea here, which is IBM. This is really just from the fact that this is a $130 stock that's now a $230 stock over the past year or so. But if you look at the business, it certainly hasn't grown that much over the past year or so. This is really where the technicals have clearly gotten well ahead of the fundamentals. It doesn't trade at what seems like a rich valuation at only 21 times forward earnings, but it's expected to grow both top and bottom line slower than the industry peers. It is slightly more profitable, but for that slight extra profitability, I don't think supports the valuation given the fact that it's expected to grow EPS at a significantly slower pace than its peers. So for those reasons, I think trading at 21 times forward earnings is quite expensive for what is effectively a hardware business. So, when you have a stock that's oversold on both daily and weekly timeframes, and you have a valuation that has clearly gotten, or rather, a valuation that clearly has gotten ahead of fundamentals, that presents a potential bearish opportunity here for IBM. So with that kind of covers what I have for you here today. Like I said, what we seem to have here is a very bullish backdrop here for equities across the board. You have sector rotation that seems to confirm a risk-on environment, a risk-on rotation, and we have quite a few different bullish ideas that we wanted to share with you here today in this type of market condition. With that, I hope this is helpful in giving you a better understanding of kind of the macro, bigger picture of equities, as well as some significant actionable ideas that you can take away for the week. with that, thank you so much. I hope you guys have a great trading day. I will be back here tomorrow afternoon for our options education webinar series. Looking forward to going over that with you tomorrow. And then after that, I'll be back here next Tuesday. Thank you so much. Have a great trading day.